If you are self-employed and you have been spending serious time and energy trying to lower your tax bill, there is a very good chance you are focused on exactly the wrong things. Not because you are not trying hard enough, not because the strategies you have heard about are complete nonsense, but because there is one specific tax that drives a massive portion of what self-employed people actually owe, and most people either do not fully understand it, accidentally ignore it, or spend years throwing strategies at it that do not touch it at all. And here is what makes this so frustrating. You can spend the next 5 years doing everything the internet tells you to do, buying rental properties, forming LLCs, writing off every legitimate business expense you can find. And if you never address this one underlying issue, your tax bill is barely going to move. The needle stays stuck, the pain stays the same. And you keep wondering why nothing is working when you are doing everything right. I am a practicing tax attorney, CPA, and enrolled agent. Every single year, I sit across from self-employed taxpayers, freelancers, consultants, early S-corp owners, people who are genuinely motivated to get their taxes under control, and I watch them struggle with the same misunderstanding over and over again. By the time this video is over, you are going to understand 3 things that most self-employed people never figure out on their own: what self-employment tax actually is, and why it hits so much harder than people expect; what does not work, meaning the strategies people swear by that almost never reduce this specific tax; and what actually does work, the specific levers that legitimately change the outcome when they are used correctly and at the right time. Let's start at the beginning, because until you understand what this tax actually is, none of the strategies make sense. Self-employment tax is not a special punishment the IRS invented for people who work for themselves. It is not a penalty for starting a business or leaving a corporate job. It is simply Social Security and Medicare tax, the same tax that exists for every working American, just collected in a completely different way that makes it feel dramatically more painful. Here's how it works for a W-2 employee. You pay roughly 7.65% of your wages in payroll tax. Your employer pays the other 7.65% quietly on your behalf before you ever see your paycheck. You never feel that employer portion because it never touches your bank account. It just disappears into the system before the money reaches you. And the employee portion gets automatically withheld from every check, so you never deposit it and lose it either. The tax is real, but it is invisible in a way that makes it emotionally painless. When you become self-employed, both of those things change simultaneously. Now you are paying both halves, the employee portion and the employer portion, and neither of them are withheld in advance. You earn the money, it lands in your account, it feels like your money. And then at tax time, the full 15.3% shows up on your return all at once. That is the shock moment. That is the conversation I have with first-year self-employed taxpayers every single spring. They look at the number and say, I only made $50,000. Why does it feel like I am in some extreme tax bracket? And the answer is that their income tax plus their state tax plus 15.3% in self-employment tax stacked on top of each other in a way that was completely invisible until the return was sitting in front of them. And here is the part that is absolutely critical to understand before we go any further. Self-employment tax is tied specifically to you actively working in the business. It is the tax on active income. That is why W-2 wages carry it, why Schedule C profit carries it, why active partnership income carries it. It is the same underlying Social Security and Medicare tax the entire time, just collected differently depending on the structure through which you earn it. Once you understand that, you understand why so many popular tax strategies simply do not touch this number at all. Let's talk about what does not work, because this is where most people are losing years of effort and real money chasing strategies that feel productive, but leave the self-employment tax calculation completely unchanged. The first one is real estate. You hear about it constantly in self-employed and entrepreneur circles. Buy rental properties, generate depreciation, offset your income, lower your tax bill. And real estate is genuinely powerful for income tax planning. Depreciation is real, long-term appreciation is real, the timing of taxable events is a legitimate planning tool. But here is what the tax code specifically says. Rental income from real estate is excluded from net earnings from self-employment unless you are providing substantial services or operating as a dealer. What that means in plain language is that if you already have business income subject to self-employment tax, buying a rental property does not reduce that calculation by a single dollar. The two things exist in completely separate lanes. Real estate helps your income tax. It does not touch your self-employment tax. If someone told you otherwise, they were either confused or they were selling you something. The second strategy that does not work the way people think is forming an LLC. This one is everywhere online, and it causes real confusion because people conflate the legal protections an LLC provides with tax benefits it does not actually deliver. An LLC is a legal entity. It is not a tax entity. If you are a single-member LLC, the IRS treats that entity as a disregarded entity by default, which means for federal tax purposes, it effectively does not exist. You are still filing Schedule C. You are still a sole proprietor in the eyes of the tax code. You are still fully subject to self-employment tax on every dollar of profit. Forming an LLC by itself does absolutely nothing for your self-employment tax bill. Nothing. And a multi-member LLC is treated as a partnership by default, where active partnership income is still subject to self-employment tax. The legal protection the LLC provides is real and worth having for other reasons. But if someone told you that forming an LLC would lower your self-employment taxes, that advice was wrong. The third misunderstanding is what I call offsetting the wrong tax base, and this is the one that trips up even sophisticated taxpayers. People understand that deductions reduce taxable income, and they assume that reducing taxable income automatically reduces self-employment tax by the same amount. It does not work that way. Self-employment tax is calculated on net earnings from self-employment, which is a specific number tied to a specific person's active business income. Here is a concrete example. A husband owns a medical practice generating significant income. His wife starts a software business that generates significant losses. On a joint return, that loss can offset the husband's income for income tax purposes. Common sense says the losses cancel out the income and the tax bill drops dramatically. But self-employment tax is calculated per person based on who earned the income. The wife's software business losses do not reduce the husband's self-employment tax from his medical practice. His active income is still fully subject to self-employment tax, regardless of what is happening on the other side of the return. Deductions reduce income tax. They only reduce self-employment tax when they are properly attributable to the specific active business generating the self-employment income and implemented in a way that actually reduces net earnings from that business. Now let's talk about what actually works, because there are real levers that genuinely change the self-employment tax calculation, and understanding them clearly is worth more than 5 years of chasing the strategies I just described. The first is legitimate limited partner status in a partnership structure. Under the tax code, a limited partner's distributive share of partnership income is generally excluded from self-employment tax, other than guaranteed payments for services rendered. The logic is that this income represents a return on invested capital rather than compensation for actively working in the business. Where a partner is a genuine limited partner under state law, functionally limited in participation and management, the income can properly fall outside the self-employment tax calculation. This is not a loophole or a workaround. It is a specific statutory exclusion that reflects the economic reality of passive investment income versus active service income. But it requires real legal structure and real economic substance to hold up. The IRS looks at whether you are actually functioning as a limited partner or whether the limited partner label is being used to dress up what is really active participation. The second lever, and the one you are most likely to have heard about, is the S corporation election. In an S corporation structure, the owner pays themselves a reasonable salary for the services they actually perform in the business. That salary is subject to payroll taxes. But any remaining profit beyond that salary can be distributed as an S corporation distribution, which is not subject to payroll tax. That gap between the salary and the total profit is where the self-employment tax savings live. However, and this is where I see people make expensive mistakes, this only works when the business is generating enough profit that a reasonable salary still leaves meaningful excess to distribute. Electing S corporation status too early, before the profit level justifies it, results in higher compliance costs, significantly more administrative burden, and often zero actual tax savings, because nearly all of the income still has to be paid as wages anyway. And the salary has to be genuinely reasonable for the services performed. The IRS does not accept formula-based compensation. Paying yourself 30% of revenue because someone online said that was the magic number is not a legal standard. The standard is what a similarly qualified person would be paid for similar services in a similar business. As profits grow, distributions can scale. Wages do not automatically scale with them, and that distinction is where the real planning opportunity lives. The third lever is disciplined deduction planning inside your business, specifically targeting deductions that actually reduce net earnings from self-employment rather than just reducing taxable income broadly. Retirement plan contributions, accountable plans for business expenses, health insurance premiums, depreciation, and properly structured benefit arrangements can all reduce the income exposed to self-employment tax, but only when they are implemented correctly, supported by the actual facts of your business, and attributable to the specific active business generating the self-employment earnings. This is the lever most people think they are already pulling. Most of the time, they are not pulling it correctly. Here's the bottom line, and I want you to hear this clearly because it is the thing that changes how you approach every tax conversation going forward. Self-employment tax feels so painful primarily because most people do not actually understand it. They are fighting a bill they cannot see clearly, using strategies that were designed for a different problem and wondering why the number never moves. Once you understand what this tax actually is, where it comes from, what does not touch it, and what genuinely does, you stop wasting energy on the wrong things and start making decisions that actually change the outcome, legally, intentionally, at the right stage of your business. That is the difference between tax planning that looks good on paper and tax planning that actually shows up in the number at the bottom of your return. If you want real tax law explained by a practicing tax attorney and CPA who works with self-employed taxpayers every day, subscribe right now. Because this is exactly the kind of content I put out every week, and the next video is going to cover something that almost every early S corporation owner gets completely wrong at the worst possible moment.